Hello everybody, it's Zach here from RealEstateLicenseWizard.com. Today I'm going to go over another 50 of our 255 real estate exam vocab terms. These terms are super important for your real estate career, and yes, you do need to know them for the real estate exam. This is the third part of this series, and so far it's gone pretty smoothly. If you're new to the channel, please subscribe for more real estate exam related stuff. That way you can pass the real estate exam no problem. Now before I jump right into it, if you want the full text version of these vocab terms, just head over to our website, RealEstateLicenseWizard.com. Click the resources tab and look at our guide on these terms. Link down below. All right, so if this is your first time, just the way this works is you're going to see the term. Going to give you guys a few seconds to come up with your explanation, and then we're going to see if your explanation matches the textbook version. Now, of course, don't be discouraged if the terms are not exactly the same, as obviously there's going to be a slight difference in words in your mind versus the words that we have. Oh, and one last thing, don't be afraid to keep score with paper and pencil and leave the score of what you got down below out of 50. Let's see who can do the best. All right, guys, without further ado, let's jump right into it. So today's first term is exclusive right to sell listing. All right, so I'm going to give you guys a few opportunities or seconds to think about this one. Come with your answer. Okay, so hopefully you guys are familiar with this term. It's a pretty important one. So an exclusive right to sell listing is when one broker is appointed as the sole agent of the seller and has exclusive authorization to represent the property. The broker receives a commission no matter who sells the property while the listing agreement is in effect. So I think the key takeaway for this one is the second part here. The broker receives a commission no matter who sells the property while the listing agreement is in effect. And I think that's when you hear exclusive right, that means that. So basically, the fact is that you could find, or if you're a broker and you are doing the exclusive right to sell listing, somebody else could potentially find a seller for the property. But because you have the exclusive right to sell, you are rightfully in a position to earn a commission. So yeah, hopefully I explained that one well. But yeah, this is an important topic, and concept. So please be familiarized with the exclusive right to sell listing. So all right, next one. Okay, executed contract. So here's a couple seconds for you guys to think about what that is. Okay, so this one is pretty easy when you guys see the answer. So all an executed contract is a completed contract. Yep, it's just a completed contract. Nothing more, nothing less. But again, sometimes when you see these terms, you have to sometimes a lot of people think too much and they're like, oh, executed contract, like what does that mean? But it's as simple as this, guys. It's just a completed contract. All right, next one. An express contract. Okay. An express contract occurs when both. Oops, I'm already jumping into it way too quickly. Okay. Here's a couple seconds for you guys to think about an express contract. Okay. Are you guys familiar with the express contract? Hopefully. I started rambling already before I gave you an opportunity. So, an express contract occurs when both parties legally establish an agency relationship. In other words, they sat down and wrote a contract stating their relationship. This is the most common method of creation for agency relationships. So, again, when you think of express contracts, just remember that they're establishing an agency or some form of legal relationship. So express contracts are slightly different than other contracts, which is why they have to be defined. And this is the definition for this one. So, all right, we'll do the next one. Okay, federal income tax. So give you guys a couple seconds to think about this one, figure it out. Okay, so hopefully you guys should be familiar with this term. If you guys pay your taxes annually, basically, federal income tax is an annual government tax based on individual earnings, typically. So, why is this important to know? Well, of course, you guys are going to be, becoming agents soon, and I think they want you guys to know that obviously you guys still need to pay your federal income tax, as well as you need to be familiar with this term so that when you're talking to your clients, and you're speaking about how much they potentially making when you're looking at houses and stuff like that, you have to be familiar with not only how much they're making gross but net, and all this tax information. um, I know I've said it before in this channel, but really, when you become an agent, you have to be skilled in a lot of things a little bit. So it's not just one thing. It's not just real estate as a whole, but a bunch of. You kind of have to be a little bit of an expert on taxes. You have to be a little bit of an expert in finances and little things like that, obviously. But there's tons more, and again, I'm going off on tangents, so I'll just go all in my head. But yeah, federal income tax, uh, know what that is. Okay, next one. Federal National Mortgage Association. Okay. All right, I'll give you guys an opportunity to think this one over. Okay, so you guys might be sitting here thinking, what is the Federal National Mortgage Association? Well, um, it's also known as Fannie Mae. Yeah, so Fannie Mae, and that's the same thing. So also known as Fannie Mae buys mortgages on the secondary market, puts them together, and then sells them back as mortgage security bonds to investors on the open market. So what's important to know about this one is because you're going to be working with clients, and you're not so you're not always going to be that involved in the mortgage process, but you are going to be somewhat involved because obviously if someone can't finance and they're not going to be able to buy a house, so you do have to be familiar with like FHA loans and how those are backed by Fannie Mae, things like that. So it's important to know what the Federal National Mortgage Association does, as well as some of the things that come with it. But we'll talk about a little bit more of that later. All right, next one, fee simple absolute. Alrighty, so here's a couple seconds for you guys to figure this one out. Okay, you guys know what this one is? So sometimes this is just fee simple for short. And basically, what it is it's the highest form of real estate ownership that is recognized by law, in which the owner can enjoy the property to its fullest extent and is only limited by government power. So, uh, you'll see soon here that there is another form of fee simple, but basically, this is the number one. This means the owner can enjoy every aspect of their property, and again, it's only limited by the government. All right, next one, fee simple to feasible. So as I mentioned, there's another one here. So uh, give you guys a couple seconds to think this one over. Okay, so um, fee simple to feasible is slightly different than fee simple absolute, and here's why. A fee simple estate is created when a condition is added on a fee simple estate. So, if the condition is met, the estate may be lost. So basically, it's kind of like the fee simple absolute, except there is a condition involved. Um, so that there could be a lot of different factors that would create a fee simple to feasible. But basically, what you need to know is that there's going to be a condition involved. So it's slightly different. And I would say that the easiest way to distinct these two is just absolute, fee simple absolute. Like that's the number one. There's no conditions, there's nothing. It's the highest form of real estate ownership. And then obviously to feasible, there is a condition involved there. So all right, next one, FHA appraisal. Okay, so give you guys a couple seconds to figure this one out. Okay, so we talked about appraisals in our very first 50 vocab terms. And if you guys remember what that is an appraisal process goes through to determine the value and the worth of a specific property. So Basically, what the FHA appraisal is the process done by an approved FHA appraiser. So this is strictly for an FHA loan. So if somebody's looking, to get their first home, an FHA appraiser is going to come in. Now, you might be asking, oh, was an FHA appraiser different than a regular appraiser? Yes, it is, because an FHA appraiser will come in and maybe they'll say something like chipped paint, and they'll be like, you guys need to handle that before you guys can purchase the property, or you need to have the seller take care of it. And there's a lot of things that can be flagged on FHA appraisals, whereas like in a regular appraisal process, they're not really going to flag those things. They'll just basically tell you how much the property is worth. And I mean, they're going to look at those things as well, and they might have some notes on like, hey, these things should be fixed, and they could increase the value, stuff like that. But the FHA appraisal is more strictly just to appraise property for an FHA loan. So hopefully I explained that well enough for you guys. Okay, next one to stick with the FHA thing is FHA loan. So come up with your best definition of what an FHA loan is. Give you guys a couple seconds here. Okay, so hopefully you guys are familiar with the FHA. Again, FHA loans are the way to go for a lot of people, especially obviously first-time homeowners, which is where it gets its name. But basically, what they are, um, they are mortgage issued by FHA-approved lender and insured by the FHA, which is of course the Federal Housing Administration. Why are FHA loans so nice? Well, because they require a lower minimum down payments and credit scores than many conventional loans. So, we'll talk about VA loans a little bit later, but basically, the next best thing other than a VA loan is probably the FHA loan. That is, the thing is, guys, that the government wants people to own property. They want people to buy houses because it's good for a healthy economy. Renting is not good for a healthy economy, and so they created these programs like FHA, the FHA loans, so that people are able to get into houses maybe after they graduate college, or maybe when they're in the middle of college and they're starting to make money. And again, they require a lower deposit, as well as often better interest rates, and they're more accepting of the lower credit scores. But yeah, FHA loans are a good thing, so be familiar with them. Okay, financial contingency. So give you guys a couple seconds to figure this one out. All right. Do you guys remember we were talking about contingencies before? So in I believe our second video, we covered contingencies and kind of what they are. A financial contingency, let's see. Financial contingency provides a way for buyers to back out of a sale of a property if their loan falls through. So let's say you're not really sure if you're going to be able to afford a loan for this house, but you get pre-approved, and you still want to put an offer in the house because you absolutely love it. Well, you can have your agent, or if you're the agent yourself, put a financial contingency in the contract, stating that if financing falls through, then they could back out of the sale of the property. They'd probably still get their earnest deposit back. In fact, I'm pretty sure they would. And basically, this is just another added protection for consumers that maybe haven't bought a house before. A lot of first-time home buyers, they're going to have financial contingencies in their contracts, because again, they're not entirely sure. Because the pre-approval is one thing, but to actually go through the process of getting finance, it's different. And you guys will learn that if you didn't already. But it's a much different process. It's much way more thorough, which is why sometimes financing just doesn't go through, and then people are in a tricky situation. But all right, let's do the next one. Okay, here we go. Fixed term tenancy or a stayed for years. So it's kind of a 2-for-1. Think this one over. Okay, so basically, fixed term tenancy and a stay for years, basically just mean the same thing. And what that is it refers to an estate that has a specific duration of time as defined in a lease agreement. So again, this is going to be a fixed time. So it might be a year, it might be 6 months, it might be 5 years, but it is a fixed time, meaning a specific duration. So it's not going to be indefinite, month to month or something like that. This is, again, a fixed time or fixed term. All right, next one, fixture. Okay, going to give you guys an opportunity to think this one over. Okay, are you guys familiar with fixtures? Hopefully. And I'm not talking about clothing fixtures. So, a fixture is an item that was once personal property but is considered real property, either by attachment or legal addition. So, uh, I believe we talked about this a little bit in our first 50 definitions. I can't remember, but basically, yeah. So it's personal property that becomes real property. So, um, you know, you could take some sort of maybe I don't know, maybe some sort of outside patio area that could be portable and you could move it, and maybe you attached it to the house. And so it then becomes a fixture because it was once personal property. Like maybe you could move it around, but once you attach it to the property and it becomes real property, it would become a fixture. All right, next one, a freehold estate. Okay, so think this one over. Okay. So, do you guys know what a freehold estate is? A freehold estate is an estate in which you have an exclusive right to enjoy the possession of a property indefinitely. Contrast to a leasehold estate where possession is limited by time period. So, if you guys remember what we were talking about just a little bit earlier, the fixed term tenancy or estate for years, well, that would be a leasehold estate because, again, the possession is limited by time. Now, freehold estate is not by time; it's indefinitely. So, freehold estate obviously would be something like, purchasing a property, whereas again, a leasehold estate would be something more like renting or leasing or things like that. But we'll go over leasehold estate a little bit later, so I won't explain too much more about that. But that's freehold estate. Okay, functional obsolescence. All right, so think that one over. Okay, you guys know what functional obsolescence is? I don't know if you guys have been paying attention. In our last video, we went over the other form of obsolescence. Do you guys remember what that is for bonus points down below? It was economic obsolescence. Remember that? So, functional obsolescence refers to the loss of property value due to an obsolete design feature, whereas economic obsolescence uh, that's going to be a loss of value due to some sort of thing outside of the property's control. So I think one of the examples I gave was maybe flight patterns or maybe a loud highway, things like that. That's going to be your economic. Now, when we're talking about functional obsolescence, maybe everybody in your neighborhood has 2-car garages, but your house only has a 1-car garage. Well, sadly, because when they take a look at all the properties in the area, they see that your property is going to lose value because that 1-car garage is obsolete. All the other houses or properties in the area, they have 2-car garages. So that's the way that works. I know that's a little bit of a confusing contract or concept, but we do actually have a video on that. So I encourage you guys to watch that if you guys um, aren't really sure what functional obsolescence is, but it's important to know. But yeah, all right, next one, and it looks like we're getting into G, letters with G. So, all right, Gap, and it's not the store. So, give you guys an opportunity to think this one over. Okay, so this one's pretty self-explanatory. A gap is just a space or pause in a contract. Basically, if you hear that maybe there's a gap going through a contract, just think that there's a pause. So maybe something came up, or maybe they purposely are giving the seller more time to leave the property, something like that. It could be anything, but all you need to know is that it's a term meaning a space or pause in a contract. All right, next one, general agent. All right, so think this one over. Okay, so hopefully you guys came up with your answer / explanation. So a general agent, what is that? Well, that's an agent hired who can perform all acts associated with a particular business that a principal has appointed the agent to. These relationships are typically continuous. So there's a lot to unpack there. First things first, general agent can do all acts associated with a particular business. So this is going to be the one of the highest, if not the highest, form of agency, if I remember correctly. And basically, again, uh, this person can act and do pretty much all acts associated. So if someone is a general agent, I'll give you an example. Maybe maybe you're going to hire somebody to sell your house. Well, you're going to hire them as a general agent. They're going to be able to do all the acts associated with that particular business. And again, this is not to be confused. Like, I know that you're probably thinking like, what, because I can understand where this might be confusing. But to make a long story short, general agent is just basically the highest form of agency, and it's the most common too. So again, when you're thinking of just regular agent relationships with clients and stuff like that, it's going to be a general agent. And again, these relationships are typically continuous. So all right, next one, a general contractor. Okay, so give you guys an opportunity to think this one over. Okay, so if you guys are familiar with construction or renovation stuff like that, you guys should be familiar with this term. A general contractor is the term used to describe someone whose main responsibility is construction, improvement, or renovation of a property. So basically, you're going to hire a general contractor to come in and do some work for maybe your property, things like that. But it's super important to know what that means. So you're familiar with, you know, all assets and kind of people involved in the real estate business. All right, next one, general warranty deed. So here's a couple seconds for you guys to think this one over. Okay, so a general warranty deed. Are you guys familiar with this? Hopefully, I know we talked about deeds a little bit before. And a general warranty deed is a deed where the grantor or the seller guarantees that he or she holds clear title to a piece of real estate and has the right to sell it to the grantee. So what does this mean? Well, this basically means that it is uh, that the seller is going to almost make a promise to the buyer that it's going to be clear title and they're clearly going to get the right transferred. So you're probably sitting there wondering like, well, why is that important? Well, it's important to kind of define this because there are different types of deed transfers, as I'm sure you guys know, quick claim deeds, things like that. And this one is going to be uh, the it's going to hold all of the promises. So maybe the seller is going to promise that they're going to get the rights to the land, the subsurface rights, um, the air rights, all those things. And we're gonna get into the other warranty deeds later. But again, this is the general one, and this means that it just includes clear title. It's clear. There's nothing in the way. It's as clear as it can be. So, and this one's going to make a little bit more sense as we talk about the other one. So stay tuned for that. All right, next one, government power. Okay, so here's a couple seconds for you guys. Okay, so if you guys are fans of the channel, you should know what this one is. We talk about this quite often because it's a super important concept to understand. Um, and the definition is brief, but it doesn't fully explain what government power. Well, I mean, it does explain it, but there's so much more to it. So, after the explanation, if you guys are still interested in government power and you're unfamiliar with it, I encourage you guys to watch our video on that. All right, that's enough of my spiel. All right, so government power. Government power is the constitutional authority and inherent power of the state to adopt and enforce laws and regulations to promote and support public health, safety, morals, and general welfare. So, what does that mean? Well, this just means that government power is the right to maybe address some sort of things like zoning or their eminent domain, um, all that stuff. So it's designed to kind of regulate homes, properties, things like that, so that people are safer. And a lot of times property is technically worth more. Now they don't regulate obviously how much property is worth, but with government powers and some sort zoning things like that, it's much more of a good place to live, and the market shows that. So that's what government power is. And again, there's so much more about this, but we have so many terms to cover. So I encourage you guys to watch a video on that if you guys want to know more. All right, government survey system. So think this one over. Here's a couple seconds for you guys. All right. So when you guys hear this, think of one word that's coming to my mind. You guys know it? Appraisal. Yes, it's a method of appraisal. So this method of appraisal is the federal system defined by identifying reference lines. The system is based on sets of two intersecting lines, principal meridians, and baselines. It is sometimes referred to as the rectangular survey system. So yeah, again, this is just another. I know that we talked about surveying a little bit earlier uh, in I think our first video or maybe our second, but this is just a form of surveying. And you do need to know, as this is a secret sauce here, you do need to know what state or what your state uses for surveying. So keep that in mind as well. If you're not familiar with that, you should probably look that up and figure that out. All right, grant. Okay, so here's a couple seconds for you guys. Okay, so in terms of real estate, a grant is just transferring of title to real property. Um, it's a pretty short definition, but that's pretty much all you need to know there. Obviously, it's different than a traditional grant, but in real estate, that's all the term is there. Okay, next one, grantee. So I'm gonna put this one and this one together. So the next one's grantee, and the next one's grantor. So let's see if you guys can remember which is which, and I'll give you guys a couple seconds to figure that one out. Okay, do you guys remember? All right, so I actually kind of gave this answer away a little bit earlier if you guys are paying attention. So a grantee is the legal term for the buyer, while a grantor is the legal term for the seller. And why do you need to know this? Well, this is just one of those terms that they use on contracts as well as in laws. Obviously, it would be much easier if they just put buyer and seller. However, they want these specific terms to what's the word I'm looking for? I guess. I mean, to be honest, I really don't know why they use these terms instead of just buyer and seller. If you guys know, please leave please leave a comment down below. No, I think it's just legal mumbo jumbo. Like, a lot of these terms, remember, they're they have multiple meanings, but it doesn't mean that you don't need to know them. Grantee and Grantor, I would bet $1 million that you're going to see those terms show up on the real estate exam, and you just need to be familiar with what they are. So, all right, next one, gross lease. Okay, so here's a couple seconds for you guys to think this one over. Okay, so what's the deal with gross leases? Well, they're just rental agreements for use of property where the tenant pays a fixed amount, which does not change as a result of changes in various expenses of the property. So, with a gross lease, maybe 3 months into the lease, a landlord can't knock on the door and be like, "Hey, your rent's higher now. You have to pay, maybe $50 more a month." No, that's not fair. So, with a gross lease, that can't happen. It's a fixed amount and it does not change. All right, next one, gross national product, or GNP. So here's a couple seconds for you guys to think this one over. Okay, so this is a term. It's more important for people in real estate investing, but it is still important for you guys. And I have seen a few questions where they do mention this on the exam. So pretty much what GNP is the total price of all goods and services produced inside a country annually. So again, this has to do with economics. It's kind of hard to explain such a big thing. If you guys are interested in this stuff, I encourage you guys to look up more information on the GNP and kind of how it's calculated and stuff like that. You don't need to calculate it on the exam, but you should be familiar with the term, especially if you are going to go into real estate investing. All right, next one, gross rent multiplier. Okay, so here's a couple seconds for you guys to think this one over. Okay, so the gross rent multiplier. You guys familiar with this? Hopefully you are. The gross rent multiplier is a ratio of the price of real estate investment to its annual rental income before accounting for expenses such as taxes, insurance, utilities. And more specifically, it's a measure of value of an investment property that is obtained by dividing the property's sale price by its gross annual income. So pretty much the formula is property price divided by gross annual rental income, and that's going to equal your gross rent multiplier. And why is this important? Well, it's a great way to find out how many years someone would have to hold the property, or how many years of rent that they would need to pay back their investment. So it's hard to explain this without doing the numbers, but basically, imagine that you were a real estate investor and you wanted to compare properties, and one property was maybe 2 million, the other one was 1 million, and you would do this formula to see how fast you could basically pay off the loan, or to return your investment. So maybe if it wasn't a loan, maybe you just paying out of pocket. How many years is it going to take to pay off that investment? And then you can compare the two, and then you can see which one's better. And obviously, you'd probably want to select the one that is better, because it would be paid off faster. So yeah, it's an interesting concept, and you will see problems with gross rent multiplier problems on the exam. And especially in states where they're big on the real estate investing portion. So, yeah, this is important to know. Okay, the Hobendom Clause. All right, another contract clause. So we did, I think we've done 2 or 3 so far. So here's a couple seconds for you guys to think this one over. Okay, do you guys remember the other contract clauses we were talking about? Well, we were talking about the defeasance clause. Can't remember what the other one was, but obviously contract clauses are super important. Why? Well, because when you're working with your clients, you need to be educated and familiar with these contracts. If your client's like, "Hey, what does this clause mean in this contract?" and you don't know what it is, that's not going to look good at all. You guys have to be familiar with these contract clauses, which is why we actually did do a deep dive video on this. So I encourage you guys to check that one out. But basically, with the Habenum Clause, or basically what that is the contract that describes the rights and interests being given. So this is the part of the contract where it specifically says, okay, you are going to receive this property, and it's going to be, from maybe like here to here, and it's going to specify like the specifics. And maybe it's going to say it's also going to come with this garage, things like that. Again, this describes specifically the rights. And Habenum clauses are like pretty much in every property contract, property transfer contract, because obviously like you need some place to describe specifically what you're getting, because how sketchy would it be if a contract was just like they didn't actually describe what you're going to be getting. So that's what the Habenum clause is. Another super important contract clause. And again, if you want to know more on that, we did do a deep dive on that one, so check that out as well. Heir. Okay. So I'll give you guys a couple seconds for this one. All right. So this one is not too hard for most people. However, we do have a lot of non-English speakers on this channel, so this one might be a little bit confusing. But this is one of those things where you know it or don't usually. But an heir is just a person who would inherit an interest or property when the owner dies without leaving a will. So, let's say maybe your father and mother had a large farm, and they put you down as the heir. So if they passed away, you would receive the farm. And basically, it's as simple as that. You are the heir. You are the heir of the property. You are the heir to, their stuff. That's what that is. So hopefully I explained that well. I know that's kind of a foreign concept for some people, but it's super important to know, especially in property law, especially, when you're talking to clients that potentially, um, are older and kind of in a position where they want to start looking at, you know, who can take over their stuff if and when they pass away. Obviously, you are not a lawyer. I just want to, underline that as well. I don't think I've mentioned that yet in this video, but remember, you are not a lawyer. Well, I mean, maybe some of you are, but the point is you can't necessarily give legal advice, but you can. What you should be familiar with this stuff. So, as I mentioned earlier, you're kind of like one of those Swiss Army knives. Like you have a little bit of expertise in all these things, because if your clients ask you these questions, you should be able to answer them, and you should refer them to the proper person. So whether it might be the mortgage company or the appraiser, or in this case a lawyer, but you still need to have a concept of what these terms and kind of what these things are. So, all right, a little bit of a tangent there. I'm sorry about that, but all right, home inspection. Okay, so what's a home inspection? So here's a couple seconds for this one. Okay. Home inspection, pretty straightforward. This is just an examination of condition of real property or real estate property. This usually takes place in connection with the property sale. So you can get a home inspection whenever you want. If you just own a house and you want your home inspected, you could totally have that done. But typically, these things show up when a property is sold or in the process of getting sold. And basically, they're going to come in, evaluate maybe, how much. Now, remember, this is different than an appraisal. An appraisal, they specifically state how much they think the house is worth. Well, home inspection is not that. Home inspection, they're just going to look at things like, okay, is there any missing shingles to the roof? Is there some chipped paint here and there? Maybe is like, is the basement in good shape? They're going to look at your appliances and see, okay. There are also home inspections sometimes cover pests as well. So maybe they're going to look for bugs, stuff like that. Not all home inspections do, but some do. So that's pretty much it on home inspections. Okay, homeowners insurance. So here's a couple seconds for this one. Okay, so what's homeowners insurance, guys? Well, homeowner insurance is property insurance that covers losses and damages. They cover an individual's house and assets in the home. It may also provide liability coverage against accidents in the home or on the property. So a little story for you guys. I'm in the process of buying my own home right now, and I had to price around home insurance. And I wasn't really sure who to go with or what to do. And basically, I decided on one company, and I ended up making the call, and they asked you all these questions, tons of questions, like about, specifically, does your house have a pool? Does your house have certain types of wires? Does your house, are you gonna have, like, no joke, one of the questions they asked were like, are you gonna have chickens? And why do they ask all these questions? Well, it's because they're trying to figure out how much liability and coverage they need to kind of give you guys, and how much risk is involved and stuff like that. That is from the property owner's perspective. Now, from a real estate agent's perspective, you need to be familiar with homeowner insurance because obviously homeowner insurance is, I'm pretty sure, like 99% required in every mortgage. I'm pretty sure 100%, to be honest. So obviously, like, typically that's included in the monthly mortgage payment. But yeah, homeowners insurance is super important. So be familiar with the term as well as kind of what it is and what it does, so that if your clients ask you about it, you can be familiar with that and give them an educated answer. Okay, HUD. All right, HUD. So here's a couple of moments for you guys to think this one over. Okay, the HUD is an abbreviation for something. Do you guys know what this is? So it is not heads up display, which I know, I'm sure some of you guys, some of you gamers or some of you car people, that's probably what you think. But no, when we're talking about real estate, what is HUD? HUD is the Housing and Urban Development, the Department of Housing and Urban Development. So this is a federal department, and they kind of help with housing development and kind of setting rules and laws and acts in place to kind of organize and make sure that everyone's following kind of like a good plan in terms again, the Department of Housing and Urban Development, you're never going to be like sending letters to them. This is more like a federal thing that you have to be familiar with. They interact more with state governments, and then the state governments pass their laws, and then that's kind of how like you deal with it. But it's still important to know because I do believe that in certain states you do have to have a few posters from the Department of Housing and Urban Development specifically put up in your brokerage. I know, again, that depends on the state, but again, it's a term that you need to be familiar with because it is important to know. Okay, implied contract. All right, so here's a few moments for you guys to think this one over. Okay, so an implied contract. What is that? Well, honestly, it is what it sounds like. It's a contract that is not a written agreement, but still legal and considered a contract in some states. That is. So basically, what does this mean? Well, imagine you're working with somebody, and you guys have a verbal agreement. Is that legal or not? Well, it depends on states. Implied contracts, though, do not work for real estate. Why? Why? Well, because federally, you have to have a written contract or sales agreement in real estate. Um, I'm pretty sure that's for like pretty much every state. But basically, why is that? Well, it's because it's much safer. Implied contracts are not as safe because, again, they don't have the written proof. It could fall into a he said, she said thing, and that's not what people want to deal with, and that's definitely not what the courts want to deal with. So that's an implied contract. All right. Next one is implied grant. So it looks like we're sticking with implied. All right. So think this one over. Okay, so if you remember, we defined grants earlier, and not the typical grants, but the real estate grants. Well, this kind of combines that with implied. So implied grants are just used to create an easement. So that's just how they're created. Again, um, you know, if you need an easement on your property, or if one of your clients is wondering about, is there an easement here? Is an easement there? This is stuff that you have to be familiar with, the terminology, all that good stuff. All right, next one, improvement. So this is a pretty short one. I'll click this one since you guys should know this, but that's just an addition or add-on to the property or real estate. So it's as simple as that. All right, next one. Ooh, an index lease. Okay. So this one you guys might not be familiar with. So give you guys a couple seconds to think this one over. Okay. Have you guys heard of this before? So an index lease, what is that? Well, that's going to be a lease that determines the rental prices by evaluating the annual consumer index and determining fair rental price. So this lease is slightly different than the other leases we were talking about. I guess more than slightly, because it actually looks at annual consumer indexes, which typically most leases don't. That's the distinction between the two. Um, it's as simple as that. An index lease could be used in a lot of, um, lower, uh, uh, well, I don't know if I want to say that, but, in some areas that maybe economically doesn't do as well as others. And basically, they would look at the annual consumer index of the area to determine a fair rental price, because obviously, you know, they can't charge rent for people that can't afford it. So they can't charge it super high if people aren't going to want to live there and stuff like that. So, yep, that's it for that one. Inspection contingency. All right, another one of those contingencies. All right, so here's a couple seconds for you guys to think this one over. Okay, do you guys remember we were talking about contingencies? Not only earlier in this video, but I believe in the first and second video. So what is this? Well, this is another part of a contract, but it is more specific to a home inspection. So basically, if a home inspection reveals a problem, the buyer can request repairs, compensation for the issue, or just cancel the offer completely. So um, let's say someone's looking for a house and you're working with them, and they live like 2 hours away, and they see this house and they absolutely love the pictures, like it looks fantastic. So they just put in like a low ball offer, like super low. Like, they don't think it's gonna, they're gonna accept it, but they figure, well, it's worth a shot. Like, these pictures look amazing. And you put in the contract that there will be an inspection contingency. So, they accept the offer, and then boom, they go to the house and the pictures don't look exactly the same. And then a home inspection occurs and it turns out there's tons of problems. Well, guess what? The potential buyer has the right to cancel the offer. And this is just another added protection for the buyer to make sure that, you know, they're not getting screwed and they're taking part of a fair transaction. So obviously, in the instance we were talking about earlier, they could request that the buyer or that the seller repairs all the stuff, or maybe pays for it, or something like that. But that's kind of up to the seller whether or not they want to deal with that. So, all right, next one, Ingress. So, okay, if you guys have been paying attention, you should know what this one is. So here's a couple seconds to figure this one out. Okay, you guys remember we were talking about egress in the previous, I think it was previous video. Yeah, previous video. And that was the right to exit a property. Well, guess what ingress is? It's the right to enter a property. And again, these things kind of go hand in hand. Obviously, it would be weird if you could enter a property, but you're not allowed to exit it. So again, that's what ingress is. Okay, next one, insurance. Okay, so insurance. So kind of think this one over. I know this is a basic definition, but still super important to know. So here's a couple seconds for you guys. Okay, so most of you guys, I'm sure, have insurance. It might be on your car, could be on your house, could be rental insurance. And insurance is just a basic contract in which an individual receives legal protection or reimbursement for any predetermined losses. So, again, this might be easy for some guys. For some people, this might be new to you guys, but that's all insurance is. It's a pretty basic concept, and it's super important not only for drivers, but for homeowners as well. Okay, interest. All right, so think about this one for a few months. Okay, hopefully you should be familiar with this term as well. Um, Interest is money paid or owed regularly at a particular rate. So interest can be a great thing, um, or it can be a bad thing. So interest could be bad if you're paying interest on maybe a credit card. However, it could be good if you have some high interest gaining bank account where maybe you have like a $5,000 in it and you're making a couple dollars, you know, interest or something a month or year or something like that. So why is interest important to us? Well, interest is important to us because you are going to see in your career some loans with better interest, better interest, lower interest rates, or higher interest rates. And again, as I mentioned earlier, I think this is the third time I mentioned it, but you kind of have to be a jack of all trades, Swiss Army knife. So you need to be familiar with, not every aspect of a mortgage, but you need to be familiar of some aspects. And you want to talk and speak, like you are familiar with this stuff, so your clients fully can trust you, and really make sure that you're representing them the best that you can. All right, interim financing. All right, so give you guys a quick opportunity on this one. Okay, so this is another short one, and I said short one because guess what, it's a short-term loan. So bad joke there, but okay, what does that mean? Well, interim financing might occur if maybe this will be kind of a drastic example, but I think it's a good one. Let's just say interest rates are at a all-time high, and maybe you know maybe they just need a small short-term loan to buy a house. So maybe your clients, they have a lot of cash on hand for some reason, and they just need like an extra, like maybe like $5,000 or $6,000. So maybe they just put a loan for 2 years, or like 1 year loan to pay it off. That would be interim financing. It's a short-term loan versus a standard loan where it's going to be spread out between maybe 15 or 30 years. So that's it for that one. Inverse condemnation. So we talked a little bit about this before, I believe, in our first video. So hopefully you guys remember a little bit about this one. So think this one over, come up with your explanation, and we'll talk about it in a sec. Okay, so I'm thinking of a word. Well, I guess I'm thinking of two words. Thinking of two words. You guys remember what these two words I'm thinking of are? When you think of inverse condemnation, what should you think of? Eminent domain. Why is that? Well, it's because it goes hand in hand. So, inverse condemnation is the event in which the government takes private property but fails to pay compensation or just compensation. So, that government takes, that's going to be eminent domain. And again, this might occur if maybe, let's say you owned property. I think I used this example when we covered eminent domain, but maybe you own property next to a highway and the government wants to extend the highway. Well, let's say they take over your property and they're like, hey, we're giving you $75,000 for your house. And you're like, whoa, wait a minute. Only 75,000? My house is worth like 150,000 alone, and the property's worth way more. Well, this would be considered inverse condemnation. You're stating a claim that they are not paying you just compensation for your property, and so you actually do have a right to sue the government for correct compensation. So that's what inverse condemnation is. And again, it's like hand in hand with eminent domain. It's like that step that occurs if eminent domain happens and condemnation happens, then an inverse condemnation can occur, and that's again when they sue the government, and that's when only if they're not paying just compensation. So okay, investment. Okay. So think this one over. So this is a short one. So you guys should be familiar with this. An investment is just the legal purchase of something um, that is not consumed today, but will create profit in the future. So think, when we talk about real estate investing, we're talking about, maybe buying a property that's, seen better days, but you can improve it, you could fix it up, and, maybe you could sell it way more later, or maybe you plan on fixing it up and renting it or things like that. But again, it's just purchasing something that maybe not today you're going to see value in, but maybe in the future you will. So obviously, there's way more to it when we're talking about financial investing and more. But when we're talking about real estate, that's pretty much the basic definition for that. So okay, involuntary alienation. All right, so think this one over. Here's a couple seconds for you guys. Okay, involuntary alienation. So using your context clues, hopefully you guys picked up that involuntary means what? Well, it means that normally people aren't a fan of that. They don't like that. Involuntary is normally without the person's consent or decision. And guess what? That goes hand in hand with the definition. So involuntary alienation, what is that? Well, that is when property is transferred without the owner's consent. So maybe foreclosure, or maybe there's a lien on the property and they don't take care of it. Those are going to be examples of that. And to go with that, actually, our next one is involuntary liens. So take a few moments to think this one over. So do you guys remember what liens are? Well, actually, we haven't covered that. Well, we will soon, but eventually we're going to cover liens. And what are liens? Well, they're claims for specific claims against a property. And obviously, there's two different types of liens. Actually, there's lots more there's two main types, but there's lots more. Anyway, involuntary liens, that's one of them. And Why are they involuntary? Well, again, they aren't created by the homeowner, and it's a claim opposed against property without the consent of its owner. So this might be, again, something like a tax lien where maybe they haven't paid the taxes for a while, so the local government imposes a tax lien on the property, implying that we're going to claim the property for ourselves unless you pay the taxes. So that's involuntary liens. Okay. J, joint tenancy. So think this one over. Okay, joint tenancy. So all this is when a property is owned by joint tenants. But the key takeaway from this is that if the interests of a deceased owner or if someone dies, that means that it's automatically transferred to the remaining survivors. So um, that's the important distinguish, or the not distinguishy, the important thing to remember. Uh, the important thing to distinguish from other forms of tenancy is that, again, if one of the tenants passes away, then the interest gets automatically transferred to the remaining surviving owner or owners. So, all right. So, land trust. Okay. We actually covered this in one of our questions the other day. All right. So, think this one over. Okay. So, land trusts are a pretty cool thing. I think they're cool, but I'm a little bit of a nerd. So, what is a land trust? Well, a land trust is just a legal agreement in which a property owner transfers the title to a property to a trustee. So, um, I know I use this example all the time, so forgive me if this is the third time you've heard this story, but I think it's my favorite example of land trust. Land trusts were used when Walt Disney was buying property in Florida to create Disney, the Disney place. Is it Disney World, Disneyland? Leave a comment down below which one it is. I always get them mixed up. I believe it's Disney World, right? I don't know. All right. Anyway, so why did he put his thing in a land trust? Well, he was able to remain anonymous, meaning when they were looking for property, they didn't know, like these people that were going to sell the property to him, they didn't know they were selling it to Disney. They just knew it was a trust. And why did he do this? Well, because he could remain anonymous. So imagine if, you're this big time celebrity and you don't want your information out there that bought this property, or maybe you want to be protected from somebody hiking up the prices. Well, a land trust would be great for you. So that's it on land trusts, and a super interesting concept. I always think it's always fun talking about those. But all right, next one, landlord. Okay, so here's a couple seconds for you guys to think this one over. Okay, so what is a landlord? Well, a landlord is the owner of a property that is leased or rented to another. So something like maybe a house or apartments or even land. I think we talked about in our second video. We talked about you could be a landlord of almost anything. You could be a landlord of maybe some area that people can grow crops on and people can grow. You could have tenants there. I mean, you could be a landlord on a lot of things, but you have to be familiar with the term, obviously for real estate career as well as the exam. Okay, a latent defect. What is that? What is a latent defect? I don't know. Here's a couple seconds for you guys. Okay, so a latent defect. A latent defect is not, keyword not, discoverable by normal inspection or the regular eye. So, and is known by the seller or homeowner. So this might be something. God, what would be a good example for this one? Maybe it's something so obscure, like, because remember when they do these inspections, it's pretty thorough, but they don't look at every single thing. In order to fully, they, they always say this, and I truly believe this. You don't fully understand everything about a house until you live in it for like 6 months or a year, and sometimes even longer. Sometimes you'll move into a house and 5 years later you'll find something you didn't even realize. Well, that's the case with this. Um, you know, inspections maybe take a couple hours most. And again, they're not able to see every single thing, but a homeowner could be familiar with some sort of defect on the property, and maybe they choose not to disclose it, which could potentially result in some legal issues if discovered later on. But yeah, latent defect, it's just not discoverable by normal inspection. All right. A lease. All right. What is a lease, guys? Think this one over. Give you guys an opportunity to think this one, come with your explanation. Okay, so hopefully you guys are familiar with leases. A lease is a contract by which one party conveys land, property, services, etc. to another for a specified time, usually in return for a payment. So again, this is going to be something like, renting property. You're going to set up a lease for them. Maybe you own, 100 apartment complex, and you're leasing 50 of them out, meaning that 50 people are paying you monthly to stay in that space and use the property and things like that. So that's going to be that. And then we got one more in this video, lease option. Okay, lease option. So think about that for one moment. Okay, so what's a lease option? Well, to go back to the lease definitions, kind of the same thing, except there's an added thing. With the lease option, a lease, they have an option to buy the property. So pretty much it's your standard lease. So we'll go back to that example I was just using. Let's say you have, I guess we'll give another new example. Let's just say you have two houses, and one of them you rent out to somebody. Well, you set up a lease option for them. So they can lease it maybe for a year, and then if they really want to buy it, maybe they can after that. That would be a lease option. So yeah, it's a good tool for some people to try out property before maybe they want to buy it. Also, maybe they need to get their credit score up, things like that. So all that good stuff. But all right, well, that's another 50 definitions down. I know I misspoke last video and called them questions, but they are definitions. So if you guys enjoyed this, please give it a thumbs up. Please subscribe for more. We're going to do another 50. It's going to come out soon. Again, I'm spacing these out day by day, so anticipate that tomorrow. And again, thank you guys so much for spending time with me. I really appreciate it. I really love the conversations we've all been having about this stuff. I think this is such a great resource for a lot of people. So thank you guys so much. All right, guys. I will see you next time. As always, this is Zach from RealEstateLicenseWizard.com. Make today magical.